You are going to be in for a treat this afternoon. Our first speaker, we've got lots going on this afternoon. We've got a panel discussions coming up. But first up, you all know her, Danielle DiMartino Booth, CEO and Chief Strategist for QI Research. Now, a little bit of background. Just said it's a research and analytics firm. But prior to that, and this is quite important for everyone that if you don't know her, she spent 9 years at the Federal Reserve Bank of Dallas, where she served as an advisor to the President Richard Fisher. And that was during the financial crisis, which was a pretty interesting time. But this is what I love. She's the author of Fed Up, an insider's take on why the Federal Reserve is bad for America. Ladies and gentlemen, please give a really big warm welcome to Miss Danielle DiMartino Booth. Thanks.
Well, thank you for being here, because it's 5 o'clock, not somewhere, it's 5 o'clock here. And if you brought a drink, that's good. We're not watching football this year because it's not a Saturday afternoon, but just in case you want to know, Arch Manning came in as probably the lowest ranked, within a few weeks of playing, as one of the lowest ranked quarterbacks of all time, and now he's beat almost all Texas records. So never give up on your team. Never hook 'em. All right, hook 'em horns. I'm gonna jump in really quickly. We've got a lot of slides to get through. I was looking through them earlier. There's a lot of relevant headlines that are popping about, but let's start with Jerome Powell. Jerome Hayden Powell, Esquire, trained as an attorney to look at all sides of all arguments theoretically. And yet, he says he's driving in the fog and that he cannot make monetary policy because he can't see through the front window shield. The good news is, if he was to look at the official data that he says he does not have, and just do and he mentioned this a few weeks ago in a speech that he gave when he was accepting an award, if you just add up all of the states together, you can get a very good sense. In fact, the national figures are revised based on what states subsequently report because it's more reliable data. But even so, the month of June was revised into the red. Now, the pandemic aside, that was the first time since September of 2015 that we had a negative print. That seems a bit unequivocal to me, but apparently he likes to equivocate. I did mention he's a lawyer. The other official data that he had in hand showed that, and this is not something that the Fed has acknowledged, which is probably making all those 786 PhDs' heads explode. Because they like to get in the weeds. They love revisions. They love data that's released 18 months subsequent to, okay, apparently so do I. But in what we saw, and what I mentioned earlier today, is that we know now that net job creation, according to 12 million US employers, who employ 97% of the country's workers, we know that net job losses began in the second quarter of 2024. That continued through the third quarter. There was a bit of euphoria around the election. It looks like we might have had a spurt of job creation, and then we fell right back into recession in the first quarter of 2025. Now, I'll give you a very quick bit of GDP math. Until we have all revisions in hand, we cannot go into GDP math and back out the income that was not produced by the workers who originally reported as having existed. So when you see really high GDP figures, question them. As for alternative data sets, we at QI Research were not surprised by the government shutdown because we've always relied on alternative data sets to get a feel for where the economy is. So that's boded well for us. I'll give you a few examples. If you were to go and search for file unemployment on Google, you would not be alone. If you're looking at 2022, 23, 24, 25, you see that red line has gone way off the charts. Now, do you think that this tells you more about jobless claims or jobless claims themselves reported by the Department of Labor. The Department of Labor, by the way, was one of these main entities that before the shutdown even occurred, 89% of US economists polled by Reuters said that they did not have faith in the official data that were being reported. I am not alone in being skeptical about what our official data statistical agencies report. If you don't believe Google Trends, have a look instead at the headlines that cross one at a time with US employers saying we're going to cut this many employees, which they do, right? If you can't control for costs or tariffs, for example, the biggest line item that you can't control for is indeed labor. And in the month of October that just ended with Halloween, we had north of 154,000 layoffs that were announced in the United States. It's a 25-month high. That seems fairly unequivocal to me, but again, the man likes to equivocate. Or you can look at workforce adjustment and retraining notifications, which by law must be filed with individual states. We add them up on a monthly basis. And right now, where we are is the highest level of workers getting WARN notices. WARN notices allow you to look for a new job if there's one to be had. But we're at the highest level since September 2009. Can anybody in the audience tell me what was happening in September 2009 in the US economy? Okay, it's okay to say the word. It was the GFC. I mean, that was a little bit more specific, but yes, we were in recession at the time. In fact, we were in the thick of recession. So we've got WARN notices at the highest since 2009. If, Chair Powell, you insist on official data, let's take a look at the recent past, bearing in mind we only have data through August. Well, I had a saucy Bloomberg anchor tell me a few days ago, don't you understand that the US economy creates 4.5 million jobs every single month? Well, this was my response. But what happens if they're destroying more jobs than they're creating, employers? Well, that's been the case. As you can see, that blue line has fallen under the zero line. And in fact, gray bars, that's what dismal scientists, me, economists call recession. The only thing missing here is the gray bar. Because over the last 12 months, that's what you're looking at, 60% of those months have seen a greater degree of job destruction compared to job creation. All of these data sets were available to Chair Powell when he took to the podium last Wednesday. And yet he's choosing to ignore them. He's choosing to ignore that the share of young adults living with their parents, I venture to say not by choice. Of course, I make really good lasagna, so I mean, mine come home anyways. But they're not allowed to live with me, until, as long as they're adults, they can't come home. Anyways, but the share of kids living with their parents is at the highest since the Great Depression. If they're lucky, they're renters. That's that green line, as opposed to that yellow line, which shows you owners of homes in the past few years declining. When home ownership is declining, it shouldn't surprise you to see this headline out of Redfin from a few days ago saying that housing turnover, the pace at which houses are changing hands, has hit the lowest level in at least 30 years. Think about that for a minute. And then there is the post-pandemic hangover. We gave people lots of money, starting with the CARES Act, 3 stimulus checks. They didn't have to pay their rent for 19 months. And by the way, they didn't have to pay their student loans for 5 years, which caused them to believe they would never have to pay their student loans. Look, it was a logical deduction to make at the time, right? But the fact is, they're now having to repay those student loans, and we're seeing it increase, an increase in the percentage of the population with a big decline. I know, why am I doing that? Increase and decline, that's not fair. But that's how the data is presented, and we're seeing a big increase in people with falling FICO scores because these student loan payments have kicked in. It's the reality of pinched budgets. It's the reality of wage disinflation. It's the reality of the lowest percentage of job entrants coming into the job market And it's not like 1988 when the entrant unemployment rate was very high. That was because that was the peak year for baby boomers flooding into the market. No, it's because the jobs are not there, which is why kids are not paying the rent. Now, you will be told time and again by the talking heads, which if you're watching CNBC, please mute it, but you will be told that the auto situation in the country, right, $1.7 trillion in debt, is contained to subprime. It's like they're parroting the ghost of Ben Bernanke. Wait, Ben Bernanke's still alive. But it's like they're parroting the ghost of Ben Bernanke, who made the same exact comments about subprime housing way back when. But what you're looking at here is people who make $150,000 or more. So they're the ones who are seeing credit card debt past due, auto loans past due. In fact, VantageScore reported last week that the fastest growth, albeit off a low base, the fastest growth in delinquencies is among those who are in the prime category of borrowers. That's produced a lot of business for the repo man. And by the way, to be fair, there are some repo women out there, just saying. But it's a fairly dangerous job. And you're always packing a gun because you're going to get shot at. But what we know right now is that car repossessions are tracking in 2025 to be at the highest level since 2009. And by the way, that is allowing for the fact that the ability to recover a car that needs to be repossessed has gone down quite a bit in the past few years because borrowers have gotten to be wiser about how to hide their car and not get it repossessed. Even so, 2025 is tracking to the highest year on record for repossessions in the United States. If you hear differently from Cox Automotive, disregard. This is actual assignments that come from lenders to repo men to go pick up the car, and you can get a luxury car, go to auction. A lot of these cars are high-end because people borrowed more than they could afford to borrow when they thought they would never have to repay their student loans and when they thought that job creation would keep going as it did, which it didn't. So where does that take us in the inflation discussion? This is where I will deviate off course from 99% of people you're going to hear at this conference. Right now, the cost of food and electricity are going through the roof. That much we know. But when we talk about core inflation, when we talk about some of the key drivers that sent inflation upwards during the immediate aftermath of the pandemic, that would be used cars, new cars. And one of the support structures underneath used car prices, because as you can see, the Manheim Used Value Index has come down off its peak, but then it stopped. And one of the reasons it stopped is because so many people during the pandemic held on to the cars that they had leased for longer than what was normal, so you had a dearth of cars coming off lease for a few years. That's over. So we're now going to see that supply come into the market. This is all important on an afternoon that we just learned that car sales came in at 15.3 million last month on a seasonally adjusted annualized rate, down from 16.5 million the prior month. And by the way, that was not all the EV credit going away. So again, back to this idea of why is Danielle talking about inflation differently than others? Until we get the Doge dividend, until we hand US households cash, and I mean cash directly deposited into their accounts, you're not going to see a repeat of this spike in trueflation, which, by the way, hit 11.7% higher than the 9% consumer price index where it peaked. Today it's at 2.7%, mostly reflecting, again, high food costs and high electricity costs. Thank you, AI data centers, for jacking up those costs for hardworking Americans. But in terms of what they can afford to pay up to buy, discretionary purchases, that is not filtering through to inflation. And neither is wage inflation when you've got this many layoffs going on, when you're in a labor market recession, as we are. So again, if Powell and others are talking about tariff pass-through, why don't you refer them to this morning's ISM manufacturing survey, which stated in no uncertain terms all of the damage of the tariffs, all that was done to our cost structure, it's gone. Now we simply have, as Eastman Chemical told us after the close this afternoon, our clients are sitting on too much inventory, and they're trying to whittle it down. When you're trying to whittle down inventory, what do you do if it won't move? You put it on sale. When you put something on sale, what occurs to the average general level of prices? They come down. Now, everybody's going to tell you that other forms of inflation are blah, blah, blah. Just remember, you can look up Truflation online, TRU. It's the only time I'll talk about the blockchain. Thank you. But it's 30 million prices gauged every single day in the United States, and it is a true reflection of where inflation is today. Is it north of the Fed's 2% target? Yes. Is the employment mandate where the Fed is falling down to a greater degree? Absolutely. But the question is, talk to anybody on Wall Street and they will tell you that we don't need to be debating a 25 basis point or a 50 basis point rate cut, which is exactly what they're debating at the Fed right now. Most investors will tell you that the next round of quantitative easing is imminent. Really? Because in order to get there, you have to go from where we are in the Fed funds rate today all the way down to the zero bound before you can launch QE. The last time we did that, there was a global pandemic that spurred that move. Even if the Fed does take the Fed funds rate down to the zero bound, you're going to be taking $71 billion of interest income out of the hands of retirees. It is not just the stock market that has supported spending. It is not just, I'm in trouble if my clicker dies. And I'll glaze over this quickly because I've got too many charts and we don't have enough time. Next time you hear somebody say that financial conditions are not restrictive, ask a small business owner how they feel about the availability of credit, because they will tell you that credit is way too expensive and that they're not Meta or Apple or Oracle. I mean, Meta has an 11% decline in its stock price a few days ago. It was just annihilated. And yet the same exact day, it sold $25 billion of bonds, and the bond sale was 5 times oversubscribed. There's something weird going on the street. Anyways, I will move on. Back to the street, yes. Fiber optics 2.0. This is what we are high on. We are high on an AI narrative that through the year 2030 is, according to the OECD, $2 trillion short on what it needs to invest for the growth that it's promising. That's a nice round figure for you to remember, $2 trillion. And whereas a year ago we were talking about AI being generated by cash flow, revenues, et cetera, now they're just selling debt. In other words, they're not even pretending. Do they need to pretend? Probably not. Because of the power of passive investing to push up the highest, largest market capitalization stocks and power them higher and higher and higher, whether it's NVIDIA or, let's look at Apple. In any event, for those of you who were wondering how magnificent the Magnificent Seven is, it's larger than Europe, market capitalization-wise. Europe, the continent. So I'm going to give you a very quick illustration of Apple Incorporated. The share price, as you see it, has gone to the moon. In 2011, Apple's global market share of the iPhone was 18%. As of the second quarter of 2025, the latest data available, Apple's global market share is 17%. Based on revenue and income and cash flow, that revised share price is where you should see Apple trading today, and yet. Because every single time money's taken out of somebody's paycheck and put into a target date 401k fund, it automatically goes in and buys the biggest capitalization stocks to the greatest extent and pushes them upwards and upwards and upwards. And this will work. This will work until it doesn't. And it makes the Fed's job a lot harder because they're trying to rein in animal spirits without talking about it. The other thing the Fed doesn't talk about is who can afford the $2,000 iPhone. By the way, they finally introduced burnt orange iPhones. Somebody finally came to their senses in Cupertino. They finally came up with the UT iPhone. So I am getting the burnt orange one from all 4 kids for Christmas. FY kids, can you hear me? In any event, most people who can afford a $2,000 iPhone, they live in this cute little area called the top 10% of earners, who now account for 50% of US spending. Think about that. Demographically speaking, we're talking about the boomers. We're talking about the silent generation who combined control about $100 trillion of the wealth in this country. So again, top 10% of earners account for a record 50% of US consumption. As for the rest of us, what have they been able to buy since 1994? That appears to be a flat line. There's a point that I'll get to, hopefully, without getting thrown off the stage, about what this implies for our economy on a long-term basis, the haves and the have-nots, the growing divide. Because I can guarantee you that even though the people who represent the top 1%, who've seen their net worth go into the stratosphere, who don't need to bother with pedestrian things like traffic because they can just take a helicopter everywhere, the people who don't have what they have, they're aware. They're very, very aware. How aware are they? This QI chart was in Bloomberg over the weekend. They ran a special, scariest charts in existence for Halloween special. And this was just made, this chart. So the University of Michigan asks households every month, what do you expect your financial security to be 5 years out? As you can see, after the stimulus checks wore off, it's absolutely collapsed. And it's moving in the opposite direction of the stock market. There are implications for people being as upset as they are, for people being as financially insecure as they are. And by the way, unless you miss the presidential election, they don't like to be gaslit. They don't. They don't like to be told that the US economy is not in recession just because somebody at Goldman Sachs or a big sell-side firm says we're not in recession when they know we're in recession, because they're in recession on a personal basis. They're in recession when less than 20% of US states are not in recession. A buddy of mine, David Rosenberg, shared this chart with me a few days ago. I thought it made quite the statement. Being in recession is also reflected in the absolute meltdown in asset prices that we've seen outside of that magnificent 7. We went from work from home to return to the office to where we are today, reality, because return to the office was supposed to make this line turn around and come down. But it didn't. This is the office delinquency rate. Office Properties Trust went belly up just a few days ago. Great big office REIT. It's going to be the first of many. The pandemic sent a lot of people offshore. AI is destroying jobs. I know it's supposed to create productivity, blah, blah, blah. How? Ask somebody how AI is going to make us more productive. I get it on an individual basis. And that is indeed where the adoption's been the greatest, is on an individual, personal basis. But in the corporate world, right now, it's just destroying jobs. Now, until that process of until the Fed goes back to the zero bound, until money becomes cheaper, we're going to continue to see the lag effects of higher for longer, which is exactly what we're seeing. Standard & Poor's last month reported that the monthly tally of bankruptcies hit the highest level in the post-pandemic era. But again, we don't pay attention to this because we don't need to. We just know where NVIDIA closed. That's it. It could be a $6 trillion stock by tomorrow for all we know. That's the power of passive investing. People are absolutely ignoring what's going on in the real economy. And when I say people, I mean people on the street, not with a capital P. When corporations go bankrupt, US households go bankrupt. And indeed, that is exactly what we're seeing. It takes a little while for the corporate bankruptcies to filter through to job losses, to then filter through to household bankruptcies. But again, that is exactly what we're seeing. So I actually have a few minutes for questions and answers because I don't drink caffeine, but I had a Coke Zero before this so that I could get through my slides quickly. So here we are. But this is the aftermath of income inequality. I used to live in Venezuela. I can tell you, before Chavez rose, I could tell you that income inequality was going to take the whole country down. Now, my children tell me I'm old, but I'm not so old that I remember personally the fall of Rome. But it too fell because of income inequality. And that is what we have today. We have the greatest income inequality our country's ever seen. And if you think about this, if you think about 18 to 26-year-olds, 46% of them, almost half, say they would prefer to be unemployed than unhappy. Where is the value system? And moreover, not to cross a line I shouldn't, but this was in the Wall Street Journal a few weeks ago. 58% of Gen Z agree with the statement that violence is never acceptable. That means the other 42% believe that it is. Income inequality has economic ramifications, but more importantly, it has societal ramifications that can then boomerang back into the economy and create a cycle. We have to find a way to rebuild the ladder so that people can live the American dream, not just the top 1%. Now, with that, I will take anybody who's brave enough, or maybe somebody who has had a martini, can ask me a question. Yes?
I have a question for you. I know you were a sound money advocate, but you also were with the Fed. Do you believe that the United States is moving toward a crypto solution for debt in terms of stable coins, whereas the East is moving toward gold and silver? China, Russia, India. What is your opinion about the USA, the Treasury Department, and the Fed regarding gold and stablecoins?
I think that the stablecoin adoption is going to continue in earnest because a lot of people have figured out that it is simply a way to digitize the dollar, digitize the US Treasury, indemnify its status on the world stage as the reserve currency status and the risk-free asset. So they're looking at it through a different prism than you are. If our country was going to get in trouble for pissing all over its fiat currency, that might have happened a few years ago. China doesn't want reserve currency status. It's a burden. It's a burden to carry. And until somebody else wants to take it from us, and when I say take it from us, I mean through war. It's the only way you ever lose it, a hot war. We'll retain it. It's as simple as that. You're very welcome. Anybody else? Yes, sir.
With the end of QT, do you think, since they're still looking to reduce MBS on the balance sheet, do you think the Fed would potentially start selling to essentially form another type of QE, sell the MBS to shift to treasuries?
Well, so refinancing volumes have gone up appreciably, and the Fed is not ending its QT in mortgage-backed securities, which very few in the media picked up on. No, they'll never sell. No. It's an entity that by law does not have to realize a loss, therefore it never would. But as prepayment speeds increase, we'll go from today's $20 billion a month in mortgage-backed securities roll-off. That will increase up to $35 billion a month. But for everybody who's looking for sources of QE, that money is being reprocessed, regenerated, put back into the US Treasury market, which is not bad for the US Treasury market if you're thinking in terms of providing liquidity. I'm very happy, by the way, that the Fed is getting out of the business of credit easing and getting away from QE mortgage-backed securities. May it never return. Yes, sir.
What are you doing to protect your financial future?
Well, my portfolio is in the fetal position. No. I'm probably sitting on more dry powder. I am and have been. If I feel that a company's dividend is lock safe and their stock's been beaten up, I like names like that, especially if there's something called cash flow as opposed to EBITDA. But I think right now in the current environment, my platinum's treated me well, as well. I don't mean what I'm wearing. But I think right now the reason that it costs so much to hedge your stock market portfolio is because you get what you pay for, and you're gonna have to pay up right now to be hedged. So be in instruments that still pay you what cash will pay you, which is around 4%. Take it, keep your powder dry, and be ready to be opportunistic. And to the extent that your powder's not dry, it sure as hell better be throwing off an income, whether it be a stock or a bond. Okay, I've got the 3 zeros. I got in 3 questions, so I'm happy that we had a few minutes for that. Thank you so much for your attention.
Please give her a very warm welcome. Thank you. Thanks, Danielle. Can we just go back?